SPAC. What is that? Hey taxpayers, it's Tiffany Gonzalez CPA here, founder and CEO of Accounting to Scale, and we're back with another installment of What is that? Where we describe financial terms and topics but make them super easy to understand. Today, we're talking about a SPAC, a special purpose acquisition company, which has to do with investing in IPOs. So if you're interested in investing in IPOs and want to learn more about SPACs, tune in and let's get started right at the beginning. SPACs. What is that? A special purpose acquisition company is formed for the sole purpose of raising capital through an initial public offering, an IPO, in order to purchase a private company. SPACs have been around for years, but in recent years, they've become so much more popular. In fact, in 2020 alone, 247 SPACs were formed and raised $83 billion. In 2019 and 2020, more SPACs were created in that year and raised more capital than they have ever done in all of the 18 years combined prior to that. SPACs are formed by investors and sponsors who are skilled in a certain area. Think real estate or retail. And their purpose is to acquire a private company within their expertise. In creating the SPAC, sometimes the investors and sponsors do have an idea of the target company they would like to go after, but they don't disclose this during the initial public offering, which was what makes them blank check companies. Essentially, investors are putting their money into a SPAC without yet knowing what company it's going to purchase. The money that the SPAC raises then goes into an escrow account. Well, 97% of it does. The other 3% is used for legal, accounting, and other related initial public offering fees. The funds that went into escrow must be used for the acquisition of the ultimate private entity that it is purchasing, or the money must be liquidated back to the investors. The SPAC typically has 2 years to make a deal go through. If the SPAC sponsors identify the target firm they want to acquire, they must then make the announcement, also known as the announcement date. After the announcement, the SPAC sponsors then go through due diligence and acquisition terms with the private company. The United States Securities and Exchange Commission also analyzes the deal and the acquisition terms. The next step is a proxy vote. The SPAC shareholders must now approve whether they agree with the acquisition. Once the business combination is approved, the transaction closes and the acquired firm now goes on the stock exchange. So what are the advantages of selling to a SPAC? These smaller companies can have an advantage because they're typically getting a 20% higher purchase price by selling to a SPAC compared to a typical private equity deal. It's more flexible, it's less burdensome than going through a traditional IPO. Also, the founders of the privately owned company that is being sold can avoid lockup periods that don't allow them to sell their stock after IPO. So, the big question here is, should you invest in SPACs? Research has found that SPACs not only lagged the overall market, but also underperformed against traditional IPOs. The Financial Times also analyzed SPAC performance over a period of time and determined that most of them were trading below their IPO price. A successful SPAC acquisition is usually super lucrative for the SPAC sponsors. And this is because they can get up to 20% of the outstanding shares for a nominal price. But SPAC investing as an individual investor has proven to be not as lucrative. Given SPAC's poor track record, many investors should be wary about investing them unless they're getting in the pre-acquisition phase of the SPAC. We hope you enjoyed this latest installment of What is that? Hit the like button and subscribe to our YouTube channel. Follow us on LinkedIn, Instagram, and Facebook at Accounting to Scale. Until the next video, your favorite CPA, Tiffany Gonzalez.